Good afternoon, everyone. Hope everyone is doing well. Today I'm going to be discussing about future value and present value. So let's talk about first the future value. Let's say you have $100 in your bank account and your bank is very nice, who handsomely pays you 7% interest in a year. How much the value of your $100 would be after 1 year? So it's very simple, right? Interest rate is 7%. 7 divided by 100, that gives you 0.07, multiplied by 100. So $7 is your total interest. So what is the value? 100 plus 7 is $107 after 1 year. Okay, so that is your future value after 1 year. The present value, right, multiplied by present value multiplied by the interest rate, you get the total interest. So total interest plus present value is your future value. Okay, so let's talk about the future value of X dollars. Okay, future value of X dollar would be simply $X multiplied by 1 plus interest rate to the power t. So here future value of, let's say, $100, let's say future value of $100 would be $100 plus 1 plus interest rate 0.07 to the power 1 is equal to 107. Right? So this is a simple formula to get the future value of X dollars. Now let's say you want to invest $100 for 2 years. So what would be the future value of $100 after 2 years? 100 multiplied by 1 plus 0.07 square is equal to 114.49. Now why did we do the square? Because it is simple that you are investing for 2 years. You are investing for 2 years, so your time t is 2 and you got 114.49. So now see, if you minus 114.49, if you do minus 100, which was your original value, right, and now you get 14.49, good, which is greater than 14. Why 14? Let's say 2 years interest is so each year you are getting $7 interest, but you did not take money out, and next year also you got $7 interest, but now it is calculated in a compound manner. So your 14.49, right, is greater than 7 plus 7, so you got 49 cents compound, extra money. So see how the interest rate R plays a major role. So it's in a compound interest manner. Good. So always remember this formula. Future value is present value multiplied by 1 plus interest rate to the power t. Now it increases exponentially because your interest rate, because of the interest rate, your future value increases exponentially. How? Let's see in the curve, in a graph. So if your interest rate is 0, then it's almost flat. Your value is not increasing, it's same. If your interest rate is 5, it has some slope. If your interest rate is 10, it's more slopey. Okay, so see how exponentially your future value is increasing with time depending upon the interest rate. So interest rate plays a big role. It's almost you may say magical thing here. Now let's talk about present value. Now turn the table around and ask a question that how much would you need today so that you can get 114.49 after 2 years, or in other words, what is the present value of 114 payoff, right? So we already saw the calculation. You can say I need $100 because you have already seen it. You have calculated future value of $100 after 2 years. But here we are saying that we have given a number 114.49. That means that much money we want after 2 years. So how much today we have to invest? So that will become our present value. Good. So how much the value would be? 114.49 divided by 1 plus 0.07. Now notice that this is just the reverse of future value formula. So in future value formula, you are multiplying with 1 plus r to the power t. Here you are dividing. Here you are dividing with 1 plus r to the power t. Here you are multiplying. In future value, in present value, you are dividing this factor. So this factor is called discount factor. Okay. 1 over 1 plus r to the power t is discount factor. Ct is the cash flow at time t. So time t, it means cash flow after 2 years is 114.49 divided by 1 plus your interest rate is 7%, 0.07, and time is 2. You got about 99.9. So this is a round off number to 100. Okay. So we can represent this factor 1 over 1 plus r to the power t as discount factor. Means you have that discounted that much from the money which you have right now to invest, so that you get 114.49 after 2 years. Or in other words, you can say that the present value is discount factor multiplied by future cash flow. Present value is future cash flow divided by 1 plus interest rate to the power t, right? So remember these formulas. The longer you have to wait for your money, the lower will be its present value. Let's say you want to invest, you need 100,000 after 10 years. So you can calculate, each like 100,000 divided by 1 plus and how much interest rate your bank is giving you. Let's say 0.07 to the power 10. You'll get some numbers. That much money you would need today. If we see the graph of present value versus time, this graph is just the opposite graph of what is between future value and time. See, if your interest rate is 0, it doesn't change. But if your interest rate is 5%, so you have to invest more today to get the same future value. If your interest rate is higher, you would need less money today to get the same amount in future. So always remember, this is a big magic. This is a big magic. Interest rate. This is a big magic. Okay. Now let's discuss present value with multiple cash flows. Suppose you want to value a stream of cash flow extending over a number of years. So this formula, present value formula for many years, say cash flow after 1 year divided by 1 plus r, cash flow after 2 years divided by 1 plus r square. So this formula, sigma cash flow after t is the variable here, which is in your sigma. This formula you can use to get the present value with the multiple cash flows. This is called discounted cash flow formula. Okay. Now, what is the net present value? So, net present value would be the present cash flow at 0 time plus your present value. So, that's called NPV, net present value. Okay. Now, let's say if you have investment. So, investment means your cash outflow. Then you subtract that number. So, it becomes minus C0 for an investment scenario. Okay. Some important points here to remember. So, it becomes let's say you have some money, you can either buy a home or a small condominium, or you can invest that money in a stock market. Okay. So, let's say you want to buy a property, you have 370,000 in your pocket and the property value is 370,000 and you want to invest. Whether should I invest to make money or should I go to stock market and invest there? So, let's say how to make decision based on present value and rate of return. So, what we're gonna do, we're gonna see what will be the value after 1 year for this property, some estimated number. And here remember, we are assuming that the stock market and the property market both are as risky as both are risky to the same extent. In real world, both have different volatility, but here for simplicity we are assuming that both have same riskiness. Okay. So, selling the house next year, your condo next year will give you 420,000. Okay. And second option is that if you invest in a stock market, it promised to give you 10% return at the year end. Now, both riskiness is same. So, what you're gonna do? You're gonna calculate the return what property may give you. Okay. So, how you will calculate the return? Okay, it is very simple. Your profit divided by your investment. So, how much profit you will get if you sell next year? 420,000 minus 370,000, that is your profit, divided by your investment 370,000, that comes out to be 13.5%. Okay. Now, what is the opportunity cost of your capital, of your money? So, opportunity cost, okay, what if you do not invest? What if you do not invest in a stock? Then opportunity cost becomes 10%. Okay. Now, 10% is the opportunity cost if you are not investing in stocks. Okay. Now, that number is less than cost of capital. That number, cost of capital, is less than your return if you invest in property. So, if your return is greater than your opportunity cost of capital, okay, then you should invest in property, okay, because it is more. Now, two rules you remember: net present value rule, accept the investments that have positive net present value. Okay. So, you should always check, this is very important, that if your present value is negative, then don't think about that investment. Present value should be positive. Then rate of return rule means accept investments that have rate of return, okay, is greater than opportunity cost. So, rate of return is greater than opportunity cost. So, these two things you should remember before thinking about investment. However, say this is a kind of mechanical way, playing with the numbers. But in real world situation, let's say your return is coming 11%, okay, and your opportunity cost of capital is 10%. Now think for a second that 11% how the property market is going. So property market, let's say return is 11 on property, okay, property P, and check the slope of the return of few years. If this is like that, that is your return. Now let's say the stock market, and stock market is giving you 10%, right, return, but both have, here we are assuming the same volatility, but what if for a second they don't have same volatility and your stock return for previous years, the curve is sharper? What are you gonna do? Think about for a second before taking a crude decision based on these two rules. So you might want to invest in stock because here the slope of the curve is bigger than the property one. At the same time, this becomes more riskier than the property. Stock becomes more riskier than the property, right? So you need to find out, what really, I mean, there are different methods when we're going to be discussing in other lectures, but I have discussed some of these things in my financial analysis lecture series. So those who haven't watched that video, I would recommend you to watch that, how to do analysis in a stock market. So it depends on person to person. Property investment is slow moving but more stable, less volatility. The stock market is faster moving, a bigger slope, but volatility is higher. So it depends on everybody's temperament. But these are basic rules: net present value and the rate of return. Positive net present value and rate of return is greater than your opportunity cost. Okay. So thank you very much, guys. Hope you have enjoyed this brief instructional video lecture on present value and future value concepts, and how to take investment decision based on these values. If you need private lessons, you may contact me. If you haven't subscribed my channel, I would recommend you to subscribe this channel. This way you will get notified when latest videos are available. And have a wonderful day. Thank you again.